Good evening, everyone. Welcome to IQI Canada Evening Talks. My name is Yousaf Iqbal, country head of Juwai, IQI Canada. And today on my live show is none other than Shan Saeed, our chief economist of Juwai IQI, all the way from Malaysia. Hi, Shan. How are you doing?
Good morning, Yusuf. Good morning from Kuala Lumpur. I am fantastic. Thanks for having me in your show again. Every month we see each other once live.
Absolutely, and thank you, for giving us an opportunity for our viewers to know, about the economic outlook of what's happening around the world and what's going on with the market around that. And people, again, if you don't follow Sean, please follow him on LinkedIn. Please follow him on Facebook. If you really want to know what's going on in the world and what's happening on that, I follow Sean, and I must say that by following Sean, it's not only we're just looking at from just an economic outlook for a specific country, but an over global economic outlook. Again, when we advise our smart and sophisticated investors, we look at the market conditions based on so many things on that, and then we advise our clients on that. So, Sean, thank you very much for that.
Thank you. It is my pleasure.
Great, Sean. So let's start our round of questions right away on that. Sean, the markets are in turmoil with S&P down 20% per year 7 days ago, and Fed is looking, perplexed. Jeremy Grantham, a well-respected financial market strategist, predicted near-term recession and stocks plummeting. I know that you follow him, and you have made the recession forecast in April of 2022 newsletter with various press and media. Where do we go from here, Shan, in the market?
Thank you, Yusuf. Yusuf, things are looking, as you rightly pointed out, the key word is turmoil. And the slide that you're showing right now, April 2022,
Yeah.
IQI shared that three variables are coming into the market. That is recession, QE5, and stagflation. And already now, uh, all the mainstream media is talking about deep recession. Previously, most of the pundits were talking about recession will come by Q4 2023. It will come much faster. So if you look at this slide, May 16th, ex-CEO of Chairman Goldman Sachs, Lloyd, made this prediction that recession, the risk of recession is pretty high. And again, Germany, Grantham, whom I follow for quite some time now, and he's very well respected in the US equity and bond markets. He has also made the similar forecast that recession is coming at a very fast pace. If I were to come up with an analogy, I would say it's just like a train coming at you, and you're not going to stop it by standing in its way. If you look at the market cap of equities and bonds globally, they were $190 trillion. And this year alone, it has lost $27 trillion. So right now, the bond and the equity market cap is standing at around $163 trillion. It clearly reflects that the markets are not settling down very soon. There will be a lot of turmoil. I said, bloodbath is a small word. Now the new word is bazooka. So I use
Bazooka.
my GMAT, yes, I use my GMAT vocabulary. So whenever some people they try to copy me, stay ahead of the game, stay ahead of the curve, I have to come up with it because I know how to do personal branding. So now I have come up with a new word. It's called bazooka. What does bazooka actually tell you? It tells you that the markets are pretty nervous. And if you see the latest report that we are sharing in a June, July newsletter, Fed is panicking. And we have shared number of times in our broadcast every month that Fed is panicking. And if you recall, once the Fed panics, it sends a negative signal to investors. Investors make all the wrong call. When investors make wrong call, they suffer. So last night I was speaking, I was invited by Elite One Academy by Dave Chong. And I said equity and bond markets can go down to zero. Bonds can go down to zero. Equity stocks can go down to zero, but not your real estate. You
That's
can
true.
still go and touch the walls of your house, the walls are there, and the walls have got value. You
That's
cannot
right.
say the value of my house is zero unless it is burned. That is a different. Even if the house is burned, it has got value.
That's
So
right.
I was sharing last night that with you, sir, I have shared with this word tangible.
Yeah.
Those sophisticated and smart investors that you are talking about, Yusuf, who understand history and economics, they're only interested in tangible stuff. And what is tangible stuff? Real estate, gold,
Yeah.
silver, agriculture, farmland, arts. These are the expensive luxury watches, luxury cars. These are the tangible stuff. But if you ask me, Shan, do you understand uh, Bitcoin? My brain goes to sleep. My brain stops functioning when somebody talks to me about Bitcoin. Bitcoin is crypto. From $3 trillion, now the market cap of cryptos are trading at 1.3 trillion. So I think the funeral is ready for Bitcoins. I don't know when to take and when the opportunities will be written about Bitcoin. So things are very bad, and we have come in with the new terminology, and that will eventually happen. We have said since April, last week of April, I have been sharing with Astro Vani that global economy is heading for inflationary recession. So, what is
Mhm.
inflationary recession? Inflation means the prices will go up because oil
Yeah.
prices are going up. There will be supply chain hiccups, the demands will go up, but at the same time consumers are facing income problem. Look at us, the saving rate has gone down, the consumption patterns are pretty weak. That shows that recession is very much on the cards. So what is recession? Recession is not a business cycle, it's a consumer cycle. When consumers don't spend, the businesses don't invest, the economy shrinks. And with
That's
rates
right.
going up, obviously it will have a squeeze on the growth of the market. And whenever Fed or any central bank have raised interest rate, they have put a halt to the growth rate. And once you put a halt, stoppage to the growth rate, you will have recession. So I think recession is coming at a very fast pace. 2023 will be tougher than 2022. 2024 will be tougher than 2023. The global economy will not recover for the next 3 years. Global economy will only recover in 2025. I have been sharing this since March, and people have been questioning me. But now many people are realizing that what Shan is saying and everything is documented. We shared in April, and now in May, everybody is talking about recession. Fed is panicking, so we are right on the dot.
That's very true. I mean, I know you've been talking about the actual asset which will always be is going to always increase, and that is always your land and your real estate, gold and silver. And I know that you always, talk about whenever I talk to you about these things, you always say that you should, since not now, since 2014, I would recall it. Since 2014, I first met with Shan. He's always been saying, so the only way to invest is into something which I can get my hands on it, which is basically, land, real estate, gold and silver. So for our audience, we're live with Shan Saeed. If you have any questions while we are doing this, please do ask us, and we'll try to answer your questions as we go along on that. So, Sean, in the latest report from Bank of America, it talks about the shocks in the economy and the impact of global economy. How do you see that, and what's the market fear for as asset prices are falling and the credit markets are cracking?
Yes, the markets are cracking severely, especially the leverage market. Once the leverage market starts cracking, it means there is something wrong in the economy. So we are seeing liquidity, default, and deleveraging happening in the leveraged loan market, which is very dangerous. Second, SIR is coming. What is SIR? SIR. There will be shocks, there will be inflation, and there will be recession. And if you see the latest interview of the CEO of Citibank, Jane Fraser, she's talking about three R's: Russia, she's talking about recession, and she's talking about rates. Obviously, what we have been sharing, she's sharing more or less the same thing, that inflation is very high. So, in order to curb inflation, the rates will go up. Once the rates will go up, the economy will stifle. And once the economy will stifle, we will have recession. And the conflict between Ukraine and Russia is taking a toll on the global economy. So already Europe is suffering a lot because of higher inflation. The closer you are in terms of border with Russia, those European economies, they are suffering a lot. So I think look at Germany, the inflation rate is pretty high. Look at other European nations, the inflation is pretty high. Inflation is about to touch over 8% by end of Q3 in Europe. So this is will be a huge drag on not only on the US economy but also on the European economy. So there are three regions last time I spoke where global
Yeah.
investors are actually looking at. You have Asia, you have US and Europe. Asia is leading from the front in terms of global manufacturing, having a market share of 52%. Europe is number two with manufacturing of 22% and US is number 3 at 18%. But right now, main focus of global investors is Asia, then they look at US, and then they look at Europe. So these are the three regions which are on the global investors radar. So again, this region, these three regions will be quite active and they will drive the global economy. Oceania is just 1%, Africa is just 5%, so they are quite negligible. But in terms of the global outreach, I mean 52 and 40%, that means 92%. These three regions carry 92% of the global manufacturing landscape. So, but again, I would say that things will get quite tough as we go into higher interest rate regime. Once we go into higher interest rate regime, because inflation will remain up. Look at oil. Oil is trading at $120 per barrel, which means 52%, 54% year to date up. Uh,
Yeah.
Gas is up. So if uh, inflation remains high because of higher energy prices, then the global economy will go into deep recession. So we are talking about inflationary recession. Some countries will have recession. Some countries will have, most of the countries will have stagflation, that is high inflation and lower growth, and many economies will suffer. So last July, we mentioned in our newsletter that four risks are coming in the economy. One is systematic risk, that is higher inflation, higher interest rate, that is happening. Number two, sovereign debt risk. Countries will default on their bond payments. It is happening right now. On 12th April, Sri Lanka made a default $51 billion on the external debt. That was
Yeah.
a big news. Thirdly, there will be liquidity risk that is happening in the market. It is coming at a very fast rate because of higher interest rate. The excess liquidity will suck into the banking system. Once the banks takes all the higher velocity of money, then obviously there will be shortage of liquidity. Then again it will create shenanigans in the equity and bond market. The fourth risk that is happening right now is fair valuation risk in the equity markets. I have been saying all along, the letter F is missing in the equity market. What is letter F? Fair market valuation. Look at any company that is listed without any fundamentals, it touches $100 billion and then it crashes. So I think market is taking a correction. It will take further correction, 10 to 15% in US and other parts of the world. So right now, investors have lost $17 trillion.
Mm.
Imagine from 1st January as of today, when I speak to you, investors have lost $17.2 trillion, which is more than the GDP size of Germany, Japan, Canada, Spain, and Russia. $17 trillion, 1 7. So I think
Wow.
market will be expecting surge, SIR. There will be shocks, there will be inflation, and there will be deep recession for many economies.
Wow. Then comes the question, which I want to ask you is that the question in everyone's mind is that, can we fight the recession from here or is the game over for Fed? And, will stronger dollar help the USA in fighting inflation? Do you agree with the strategy from Fed?
No, Yusuf. You can only fight recession when your discount rate is between 4 and 5%. Right now, the discount rate is 1%. You can't fight recession at 1%. You
Okay.
need to have interest rate between 4 to 5% or above 5 to percent in order to fight recession. So is not in a position. ECB is not in a position. Already the governor Bank of England said that by end of this year we will have 9% inflation in UK, and then next year we will have double digit inflation. So All these three big central banks, they are not in a position uh, to fight recession. As far as Fed strategy, Fed is trying to create a different strategy this time around. They are playing with the exchange rate. Normally, what happens when your inflation is up, you increase the discount rate in order to tame inflation. That is not happening. So the Fed strategy is that increase the dollar, uh, have strong dollar, support strong dollar, so that the imports that are coming into the US will take care of inflation. But that is not working for US. The other thing the Fed is doing, they want to create an illusion among investors that US dollar is a safe haven. That's why they are increasing interest rate. That's why you see in the last 24 months, Fed has printed $4 trillion. In the last, the 70% of $100 bill are outside US. So imagine last 2 weeks ago, China and Japan, they offloaded the US Treasury holding. US dollar index was trading at 104 2 weeks back. Now it's trading at 101. So it has gone by 2.5%, 3%. So again, the Fed strategy is the same what happened in 1937. Fed was increasing interest rate and the US dollar was strong. It was not working in 1937. It will not work this time around. It's a failed strategy and Fed is again panicking. And if you read Wall Street Journal and Financial Times this morning, President Biden will be meeting Jerome Powell to ask him, my dear friend, are we in a position to fight recession? Are we in a position to fight inflation? And Jerome Powell will politely say, Mr. President, no, we are not in a position. The tough times are coming, and we have to suffer for the next 3 years, and the global economy will only recover in 2025. Asia will be leading the growth story of global economy, while US and European region, they will be a slowdown in their economies. So I think Fed is not in a position to fight recession, and inflation is here to stay because of higher oil prices and geopolitical risk is getting deeper into the markets.
Talking about the higher oil prices, I think something which we predicted last year on the oil prices, and what was the prediction, Shan? I'm sure we've gone very high on the prediction, right?
Yes, please. I gave my interview last time to Star newspaper, and I said
Yeah.
87 and 117 for the rest of the year. And now oil is trading at $120. I
I
think Star
know.
newspaper will come back and say, Shan, can you please revise your outlook? I
Even
think
before that, also last year, also we were talking. And he said, this oil price is going to go up. It's a matter of time. The oil price is going to go up, and I know I very clearly remember you saying that it will very easily crossing the $100 barrel market. When everybody at that point they was thinking, no, no, that's not going to happen. We were sitting at what, $60, $65, and then the $100 seems like an impossible sort of a scenario in that. But of course, your prediction was very accurate at that point in time as well.
Yusuf, those countries like Canada, they will tend to benefit. Malaysia, they will tend to benefit. Indonesia, they will tend to benefit because they're oil producing nations. GCC, Dubai,
Yeah.
Umar is sitting in the ideal place. GCC, all these countries who are oil producing, they will benefit
Yeah.
because oil prices will stay higher. Capex is not coming back. Capex will take some time. Maybe next year the capex will come back. But right now, those oil producing nations will tend to benefit because the government will have more money on the
Yeah.
fiscal side because the revenues would go up through higher oil prices.
True.
But those countries like Pakistan, India, who are
Yeah.
importing oil, for them it's very, very challenging. How to
Mm.
make budget? What is the price of oil to set when you're making the budget? Is it $100, $110, 120? No, so nobody knows. The geopolitical risk is getting so severe in the market. So exporting countries of oil, Alberta oil sands will remain hot. Calgary will remain hot because of oil
Yeah.
basins over there. But those countries that are importing oil, yes, it will be tough for them. So oil prices will stay higher. I think next week or maybe end of June, I have to make a revised forecast for the rest of the year. I think it's going higher, it's not going backwards. So
Right.
way I see oil and gas prices, especially there are two triggers. There are, in fact, three triggers. If Russia says that I am going to cut production further, and Saudi Arabia does the same, then it will have a serious repercussion on the energy market. Number two, if all the European nations they start, although already they are doing maybe making payments in ruble. That's why ruble has become stronger. From 151 is now trading at 66. If most of the European nations they say we are not paying in US dollar or euro because Putin is not accepting euro, Putin is not accepting dollar. He's saying either you pay in Chinese yuan or ruble. European nations will be paying in ruble because 95% of natural gas that the Europe was supposed not to consume, they have already consumed for the summers. They will have serious problem for the oil and gas. So if once they start making payment in ruble, it will have a serious problem for US dollar. Petrodollar will have, the market share will go down. Already Goldman Sachs in their report in March said the outlook for US dollar is quite bearish. We have already shared in our last broadcast. So I think, and the third trigger, if you recall, 15th March, Wall Street Journal, Saudi Arabia gave an indication. The Crown Prince Mohammed bin Salman said, we are willing to accept Chinese payment in yuan. We are willing to accept, willing to give oil to China, and we are willing to accept payment in yuan. So that was quite a statement. If Saudi Arabia announces that we are accepting payment in yuan, and Saudi Arabia is the biggest country in GCC, biggest economy of GCC, sorry. So other countries will follow. So I think uh, we are heading for uh, serious
Yeah,
challenges in the market, and that will put a lot of countries under pressure, especially
yeah,
Europe,
yeah.
and the oil producing nations will tend to benefit. So I think
Benefit
oil
from
prices will tend to stay higher. I don't see, I can say that right now, what I can foresee, oil prices will be trading between 110 and $145 per barrel by end of December 2022.
wow, 110 to 145. Wow, that's
110 to 145 I haven't shared, but I will share the same when I give my next interview with Star newspaper. 110 and 145 is the call of Juwai IQI for December 2022.
2022. Wow, wow, wow. Well, that's I always appreciate your insight on that. Again, what you were saying right now that investors have lost $17 trillion in global equity market. Stock prices have been hammered by forces that appear in nearly every cycle, such as rising interest rates and slowing growth. I mean, they're also including like rapid return of inflation after decades of low ebb. A wobbling Chinese economy, a war in Ukraine that shocked the commodity markets. Everyone is on the edge as stocks fall further. Do you foresee any recovery in the short term of the equity or the bond markets? I know you always said that, but what's the growth outlook on this?
Yusuf, I fear that the growth outlook is very shaky for many economies.
Hmm.
You have given all this analysis that you asked in the question. I think you're absolutely right. You are 100% correct that markets are wobbly and investors are nervous. And the number one thing, who drives a market? The investors. When you have liquidity, because investors bring in liquidity. Once investors they retreat from the market and they don't invest, that's where the problem starts. Because it's a human psychology. Once you have fear in your mind, you stop working in the market, you stay away from the market. You tend to believe that once the market will settle down, only then I will come back into the market. So that is one strategy. The second strategy is, in every risk factor, in every risk situation, there are opportunities as well. If there are risks, there are opportunities. So there are some investors who would play aggressive, but many investors, I fear, they will retreat from the equity and bond markets because they have so many fears. They have fear of Fed's decision of higher interest rate as a systematic risk. They have fear of higher inflation again as a systematic risk. They fear there will be liquidity risk. What happened in the repo market and the reverse repo market in September 2019 till January 2020, and last June there was a crisis of liquidity in the reverse repo market. So the way I see things, there will be a lot of challenges. A growth outlook will remain under pressure for many economies, especially in Europe, in US. Growth will happen in Asia, where you have rising middle class, you have rising income, modern infrastructure, macroeconomic stability, and most importantly, the productive labor force. That is the key for Asia. And once China comes back into the market, maybe in July, August, I think we will have more traction in Asia. But right now, I can easily say that the markets are in a turmoil. The word that you have picked up in your first question, turmoil will remain in the market and investors will remain nervous. I don't see confidence coming back into the equity and bond markets. There is an asset flip in the last 1 year we have been sharing. Equities have become bonds and bonds have become equities, and everybody has become a daytime trader. So this will remain for the next 6 months or so. I don't see the market settling down, especially the equities and bond markets. The investors will get punished, and this will happen because the Fed has lost control of the market, and they don't know how to control inflation. They don't know how to give confidence back into the economy. So this will put a tremendous pressure on the policymakers who are devising strategies how to maintain macroeconomic stability not only in US but also in Europe and also in Japan and UK.
So growth looks a bit difficult on that side. So my final question to you, as always, is that Canadian market update from a global perspective. What's your viewpoint from sophisticated and smart investors on the Canadian market economy, especially and also about the Canadian dollar as well?
Yusuf, by the way, Canadian dollar has appreciated from 128, is now trading at 126.
Yeah,
Uh, Even if the Bank of Canada it raises interest rate, I don't see the market stopping because, as I said, Canada has really positioned herself, in a manner that everybody thinks that Canada is a very safe country. There is
yeah,
macroeconomic stability.
yeah,
The policy consistency is there, education level, healthcare, everything is so perfect that everybody would like to relocate to Canada. And on top of that, yesterday, Prime Minister Trudeau, he has come up and he has discussed with his cabinet members there should be gun controls. Right
yeah,
now, there is a serious problem in US. What
yeah.
is in the last 6 months, we have seen
That's
three or
true.
four shootings, especially
True.
in school and colleges and these malls. And at least in Canada, you don't have this problem because the
That's true.
government is totally committed to curb this menace. And that shows the government is serious to maintain stability in the country and to provide calm peace to the investors. So when
Yeah.
investors will come in, and you have been sharing with me last April that Shan, on every listing there are 40, 45, offers on
Which
one
are coming
listing,
in before. Yeah, yeah.
and that clearly reflects the interest in the market. And the second thing I recall from your conversation, our discourse, that you said that there is shortage, the supply shortage in
True,
Canada is
true,
really putting a lot of pressure on demand. That's why the
true,
listing, every listing, there are so many investors. 5 years
true,
ago, you would say, Shan, on every listing there are 2 to 3 offers, or
true,
maximum 5. Now, after 5 years, look at the market is hot. So I think, as you rightly pointed out, those sophisticated and smart investors, short term, they will say, oh, interest rates rise, no problem. Still, we need to buy a house. Still,
yeah,
we need to buy an apartment. So no problem. Just lock in and buy. Because if we lock in at this time, once the interest rate will go higher from here, it's better to reduce your cost
true,
at this point of time, rather wait for 6 months. The interest rates are not going down.
yeah,
Let me say this, globally, we are into higher interest rate regime. So if you can lock in your loans right now and you can buy properties, I mean, this is an ideal situation. And for Canada, you have mentioned that 1.2 million people will be coming in the next 3 to 4 years.
true, true,
1.2 million people need
yeah,
house, they
yes,
need food, they
yeah,
need clothes.
yeah,
Who is going to supply that? So if the supply is not there, it will again put a lot of pressure on the demand. So I think Canadian real estate market will remain hot. You will be busy. You won't be talking to me, and you will only talk to me once in a month, and we will be live. And if I call you, you will not pick up the phone and say, Shan, I'm going to meet my potential client. He's interested in buying property and has got $2 million. So I think I can say safely that Economist magazine last year said the average price of Canadian real estate market is around $1.1 million. I can easily say by end of this year, the average price of Canadian real estate market will be between 1.2 to 1.3 million dollars.
So just to add what you rightly said, Sean, in terms of the prices, although when you said the interest rate goes up, there's always a little slowdown in the market. Surprisingly, I just got a call from one of my investors this morning, and he's outside the country, and he called me and said, "Yeah, so what's going on in the market? By the way, I've got this much of money. Where can we invest? So just let me know on that." Even though people are thinking, "Oh, this is a change going on in the market. That the market is going to go down." But it's very normal every time when the interest rate goes up on it, the market slows down on it, and that affects the market. But I absolutely 100% agree with you that in terms of the Canada market itself, very very well as a safe haven for the family from economic policy and also in the long term perspective. And also what we are seeing is that even though the again I always say that market is always cyclic adjustments. You will see that market will slow down, the market will go crazy on that. That always happens. But again, the fact still remains, just looking at some of the reports, everything is that there is still a low supply and a very high demand. So every time it's a buying pattern for the people, it changes. They always everybody's aggressive and they will slow down. Everybody wants to watch the market, see, hey, what's going to happen? Am I going to get a deal on this market or not? But believe it or not, I feel like, if it slows down a little bit, I always tell my buyers, do it now because it's going to happen overnight. And we've seen that happening at overnight. Several times I've seen it, Sean, that all of a sudden it will go down and then people think, oh no, no, it's going to go more down, go more down. And within 3 to 4 days, you will see multiple offers coming in. You will see again going up and it's, that was the right time I should have bought it on that. So I totally understand where you're coming from and totally agree on that. Thank you very much, Sean. Anything else you want to add for our audience before we say bye to them?
I think I would encourage you, Yusuf, if you can share a newsletter. And we have
Sure.
been discussing with people who are your sophisticated and your smart investors who are listening to your broadcast. Share the newsletter with them and try to educate them that a Canadian real estate market is still very attractive. The
Yeah.
supply is low, the demand stands very high. So this is an ideal position. And those sophisticated and smart investors, history has taught us, who understand history and economics, they've always taken position in real estate. And real estate is now becoming a new global currency. Look at sovereign wealth fund of
Yeah.
Singapore, GLC. You can share with your investors. They have invested £3 billion in the UK Student Housing Society. So
Mhm.
that shows when a sovereign wealth fund comes into the real estate, it sends a positive signal to the market that the real sovereign wealth funds, they are moving away from equities and bonds, and they're coming into real estate. And there's a lot of money that sovereign wealth funds are holding, $90 trillion that sovereign wealth funds are holding. And if this money comes into real estate, again, the money is already there. But once they start moving their money in this year and next year alone, I think that will be a huge impact. It will be a bullish trend for the real estate market globally.
Thank you very much, Sean, for your insights. Thank you so much for giving us time. Thank you so much for the economic update. We really appreciate it. Very interesting session. As always, I thoroughly enjoyed the session, and it's always a pleasure talking to you. So thank you very much. Take care of yourself and have a wonderful day. And bye for our audience right now. Thank you. Bye bye.
Thank you, Yusuf. Thank you. Bye bye.